I view that this period is fairly inevitable. And any asset that becomes $1 trillion liquid asset is going to get ETFs built on it in some jurisdictions. And in the United States case, we have some degree of separation of powers. And so even though the SEC didn't particularly want this, they lost in court. And so people want this. And so now more people can access it. There are pools of capital that, there's retirement accounts, there's managed assets, and a lot of them have not been able to access it. And now they can.
Despite the rising demand for Bitcoin facilitated by the approval of 12 spot Bitcoin ETFs in the United States, numerous investors maintain reservations regarding these products and their potential impact on the leading cryptocurrency network. Critics have raised concerns about centralization, the potential co-opting of Bitcoin, and the risk of future confiscation. While acknowledging the validity of some of these concerns, distinguished investment strategist and macro analyst Lyn Alden argues that the benefits of spot Bitcoin ETFs far outweigh the risks. Alden is optimistic that these ETFs have the potential to significantly contribute to the ongoing expansion and enhancement of Bitcoin. According to Alden, this development was bound to happen. And in this video, we will watch as she explains why. Give this video a like to show your support, and subscribe to the channel so you'll always stay up to date with the latest crypto news. Thanks and enjoy.
Stop, you don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So, and there's like imbalances built up. So the fact that they could only access it with like grayscale has been an issue. And now there's kind of like this big release valve where a lot of capital can finally get out of that big entrapment and move to other places that are kind of more professionally managed or cheaper and things like that. So I think that's a process that's inevitable. I think concerns around centralization are somewhat overblown. Not to say that they shouldn't be brought up, but basically I think that there already was a pretty big chunk of Bitcoin sitting in grayscale. Now it's rotating into BlackRock and Fidelity and a few others. The overall pie is growing moderately that's in those environments. A lot of people in those environments, they prefer that. Whereas I think it's important to say make self-custody reasonably easy for people to make sure people understand the risks. But I think, again, it's just people have more optionality now. There are a lot of people that wanted to have Bitcoin in their 401k and couldn't. Now they have more options, or they have assets with an RIA, and he or she is just unable or unwilling to put some of that money into Bitcoin. Now they can. And so I think that's inevitable. Even if it's not good or bad, it's just inevitable, right? So it's not like I see people saying, oh, Bitcoin deviated from its mission because ETFs exist for it now. Well, it's like, well, Bitcoin didn't make the ETFs. The fiat system made ETFs for Bitcoin. And that's basically the fiat system upgraded its APIs to plug Bitcoin in this method. ETFs are basically an API into different asset classes. They decided to plug into Bitcoin now. And, you watch out for big centralized honeypots, whether it's ETFs, whether it's Binance, whenever a lot of Bitcoin are in one big custodian, that is a risk. So right now, a lot of them are in Coinbase. I consider that not ideal. So I think people should be cautious about that. If you're going to hold ETFs, you probably should diversify across custodians. But I also think that, it's good to take self-custody. And so, we'll see where that shakeouts over time. But I think that that's just an inevitable stage that Bitcoin was always going to go through if it was ever going to get as big as it has now. I think there's a risk, but I view it as overblown because I view Bitcoin as well designed as is. It has a block size limit for a reason. And, I think that basically the market forces will play out. I think, basically, if you view what Bitcoin is the most immutable and decentralized database we've ever made as humanity. I think the biggest killer use case for that is money. If you have a really good decentralized open ledger, money is like by far the biggest addressable market for that. That's like $100 trillion market in today's dollar terms. It's a massive market. The total addressable market for that, in theory, is huge. And you can use that. You can timestamp other things to prove that they were not changed. You can use it for speculative meme tokens. I think most of those that's at most a few $1 trillion market, non-monetary use cases for the most immutable database. I think that over the long arc of time, the monetary use case is way more denser. It's a way bigger market, and it pushes that aside. I think that while Bitcoin gets adopted, as it goes through, as more people look at it and figure out things they can do with it, it goes through these manias, it goes through fads. I think they burn themselves out over time. We see when you look at the altcoin space, you go through this boom for a period, and then we forget that narrative. We go through the next big boom, and then we forget about that narrative. We go to the next big boom. Now, kind of the current cycle is nothing particularly new, but taking some of that other stuff and putting it on Bitcoin. I think this is going to go through a big boom, and then that kind of washes itself out. And I'm sure someone will think of the next thing, and it will go through that fad, and that can be disruptive while it happens. But I think that ultimately that it's not particularly economic. If people want to, if there's demand for meme coins, there's an endless supply of meme coins that come to the market until they saturate that demand. And then all those people that bought meme coins basically get poor. And then the money flows to the miners. And it's annoying for people that are trying to use Bitcoin monetarily for that period of time. But at the end of the day, they still have their money. All the people that bet on JPEGs and meme coins are poorer now, unless they were the handful of sharks at the top that were basically chilling it and cashing out at the top. And, those kind of sharks make money, but most people lose money. And then it kind of goes back to stability. So I think that's kind of part of something that it has to go through.
Before we proceed with more insights from Lyn Alden, here's a brief update on the ETFs from senior Bloomberg ETF analyst Eric Balcones. Despite a recent dip in market sentiment within the cryptocurrency market, BlackRock's IBIT and other Bitcoin ETFs continue to surpass all previous records and expectations. Eric recently highlighted another significant achievement for IBIT and 3 other Bitcoin ETFs in a post, stating, IBIT ended up with 414 reported holders in its first 13F season, which is mind-boggling, blows away record. Even having 20 holders as a newborn is BFD, highly rare. Additionally, Eric provided a comparison of Bitcoin ETFs to other ETFs launched in January, accompanied by a chart illustrating the number of holders for 20 ETFs introduced in January 2024. Leading the pack are BlackRock's IBIT, Fidelity's FBTC, Bitwise's BitB, and ARK Invest's ARKB, while other ETFs significantly trail behind. The introduction of Bitcoin ETFs has made Bitcoin easily available for thousands of institutional investors, a segment previously untapped for the first 15 years of the crypto asset's existence. This shift, though recent, is already impacting prices significantly. In another tweet, Eric disclosed that Millennium Management LLC, among the largest investment management firms globally, holds the largest investment in Bitcoin ETFs, totaling around $2 billion. The tweet asserts, Millennium is king of the Bitcoin ETF holders with about $2 billion across 4 ETFs. This is out of over 500 holders. Majority are investment advisors, but a big dose of hedge funds. You can never be totally sure what hedge funds are up to, but they were definitely big buyers. According to an SEC filing, Millennium Management allocates about 3% of its $64 billion fund to Bitcoin ETF holdings. The global investment management firm also possesses over $844 million in ETF shares under BlackRock, alongside another $800 million in Fidelity FBTC. That said, let's return to Lyn Alden's interview as she speaks further about Bitcoin's strength.
First heard about Bitcoin back in like 2010 or so. And I was never one of those people that was like adversarial toward it. I was never like, oh, that's stupid, but I was kind of like, what's the chance that works? Or that sounds neat. I should probably put more time into it, and then I never get around to it, right? So it's kind of like neutral toward it, or like I'm rooting for those guys, but what are the chances that this is the money that finally, is Hayekian money? And but when you watch it go through like 3 cycles of, it has a big adoption cycle, it goes down 75% or more, it recovers, goes up to another big cycle, goes down. Over, kind of every cycle, I would go and like look at the ecosystem and see the UX was getting better. And so I finally was like, okay, I have to put the time in to understand this. And so I did that back in 2017. And then I watched the block size war play out. And all of that was very informative. Basically, it kind of showed things in practice. Who controls the network? How immutable are the rules of the network? How do network effects work in this industry? Is the ultimately, I mean, Bitcoin is control logic. It's a system. Is the system stable? And when you see it operate through multiple environments, the answer is yes. And so basically, once I saw Bitcoin reach a degree of critical mass and prove itself as fairly anti-fragile, I said, well, if no one can kill this thing, And if it is now kind of critical mass of network effects, then that has macro implications. Now there's a money that moves faster than fiat while being scarcer than gold. And that has macro implications. So for example, there's 160 different fiat currencies in the world. All of them are local monopolies of their own jurisdiction, and they control that monopoly in a handful of ways. One is they tax everything other than their own currency in their jurisdiction. But then two, they control the inflows in and out of that country, right? So if you want to bring value into a country, there's really two main ways to do it in the pre-Bitcoin era. One is ports of entry, which are obviously pretty easy to surveil. Some gets through, but it's pretty limited. And then two is wire transfers in and out, but they're also surveilled and controlled. Whereas when you have internet money, anyone in that country can just hold up a QR code on a video call and I can send it to them. They can send me a payment string. They can, so every person in that country that's internet connected can get money from outside. The borders of that money are now way more porous. So they're less locked into their local monopoly. More can go out and participate in the free market of monies around the world. So if they want, and the same thing applies to some extent with stablecoin, which is that they can say, well, instead of Egyptian pounds, I want US stablecoins to hold for the next 3 months. And they're centralized, but it's a market of money now. So they're saying, well, instead of my local currency, I want something that's reasonably stable that I want to hold. And so, they'll get stable coins. If they want something longer term, they'll get Bitcoin. And that has macro implications. That breaks apart all those borders. And then when you look at macro, size matters, liquidity matters. Just because something exists, if it's not being understood at scale, then it doesn't really matter yet. And so in the first 10 years of Bitcoin's history, it wasn't really at a size that really impacted macro. Whereas in the past 5 years or so, it finally got big enough where it's starting to have an impact. Similar for stablecoins, these things matter on some sort of macro flow scale now. And so they can now change how currencies operate, because now, for example, various currencies are under more pressure, which I think is good because their people have more options to escape those currencies, and they can hold whatever currency they want. I think Bitcoin's the best one, but if they want to hold dollar stablecoins or gold-backed stablecoins or whatever, they have various kind of choice now. And the fact that all those financial borders are super porous allows market forces to exist on money in a way that it's been stopped from doing for the past many decades because of these kind of enforceable local monopolies.
Lyn Alden believes that the benefits of spot Bitcoin ETFs outweigh the risks. Do you agree with her? And do you believe these ETFs positively or negatively impact the cryptocurrency network? Why or why not? Share your thoughts in the comments section below and keep the discussion going. If you found value in this video, do give us a like to show your appreciation. Subscribe to the channel to stay updated on the latest news on crypto and digital finance. Click the notification bell so you never miss out. Thank you for watching. We'll see you in the next video. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.